Hey guys, it's Jeff Trapp here with the Tax Planning Pros, and I'm so glad that you've decided to join me today for the Jeff Trapp podcast. We are in the thick of it. It is tax season, and we've got the March 15th filing deadline coming up here very, very quickly. If you have an S corporation or partnership return, those returns will be due on that date. But what I want to talk about today is retirement planning and how you can get a tax deduction when you plan for retirement. So, what I'm going to dive into are various retirement plans that will give you a tax deduction. Now, these are considered tax deferred retirement plans, most of these plans. So, what that means is if you contribute to the retirement plan this year, you're going to get a tax deduction at your tax rate. And when you pull that money out when you retire, you're going to pay taxes at whatever the current tax rates are. Now, we don't know if the tax rates are going to go up or down. However, I do not think they're going to go down at all because, in the last several years, we printed 40% of all the dollars in circulation during the COVID-19 pandemic. And Social Security is supposed to run out by 2032. So what are they going to do to fund these programs as well as the additional government programs? I know that the government is really in debt. So the former comptroller or CPA of the United States, David Walker, who served under President Clinton and President Bush, has come out and said, well, we're going to have to double the tax rates to pay for all these government programs. And you're thinking to yourself, oh my goodness, that's insane, right? Well, let's take a step back and really analyze what that means for most Americans. Well, the tax code is on a progressive tax rate system. So if you earn X amount of dollars, you pay, that first amount at 10%, and then 12% is, the next tier, then 22 and 24 and 32, all the way up to 37%. And so what that means for most Americans is they'll pay tax, federal and state, somewhere between 48 and 52%. That's most Americans. Obviously, if you're wealthier, you're going to pay a lot more. If you live in a higher income tax state like New York and California, you could pay, closer to 60% in taxes when you pull that money out of retirement. So you have to plan strategically. So today, I want to dive into a few things that you can do to not only save for your future, but also get a tax deduction today. Now, I'm going to do a little bit of reading here because there are certain income limits or contribution limits, I should say, for each of these retirement plans. I don't want to misrepresent them or misquote them. So if it does look like I'm reading, I am on the specific topics and items because I want to make sure that you have the most correct data. And the cool thing is we'll actually give you a cheat sheet for the retirement planning. If you'd like one, you can subscribe down below to our free tax playbook. You'll get a text message from us. All you have to do is text back retirement, and we will send you this cheat sheet. So the first thing I want to talk about today is a SEP IRA. This is for sole proprietors and partnerships, as well as S corporations and corporations. But there are different limits when you have a SEP IRA. These are really cool because they're easy to set up and administer, allows tax deductible contributions. Contributions are made solely by the employer. So if you have employees, you cannot have a SEP IRA because you need to have a retirement plan that they can actually contribute to. And, contribution limits are based upon a percentage of self-employment income or wages if you have an S corporation or corporation. So if you have self-employment income, you can contribute up to 20% of your self-employment income, but not to exceed $69,900. And if you have an S corporation or a corporation, you can contribute up to 25% of your wages, W-2 wages. So if you have a W-2 at $100,000, you can contribute up to $25,000, but not more than $69,000. So you could pay yourself a very, very high wage and max that out. The next thing I want to talk to you about today is the 401k. Now you have many different types of 401ks. You have the individual 401k, the solo 401k, and the maximum here and why we like the 401ks, it allows both employer and employee contributions. So if you have employees, this is a great retirement vehicle. Contributions are tax deductible and grow tax deferred until withdrawal. So you get taxed at the end there. And then, contribution limits can be higher compared to other plans. And then, we've got this is ideal for those with substantial self-employment income. So the maximum contribution if you're a sole proprietor or partnership is $23,000 or $30,500 at 50 or older. You can contribute 20% of your self-employment income, but not more than $69,000, considering both your employee and employer contributions. And if you're over 50, you can contribute up to $76,500. So that's a great benefit. Now it's a little bit different. If you have a corporation or S corporation, it's same limits apply, but they consider 25% of your wages, but not more than 69,000, considering both your employee and corporate employer contributions. And the max is $76,500 if you're 50 or older. So that's a great retirement vehicle as well. And the next thing here we want to talk about is the simple IRA. Now, this is, very, very similar to the SEP IRA, similar to the 401k, but with a sole proprietorship and partnership, you can contribute up to $16,000 a year. That's the max employee contribution, $19,500 if you're 50 or older, plus either on the employer side, a matching contribution equal to the lesser of 3% of your defined self-employment income, or the amount of your elective deferral, or a non-elective contribution of 2% of your defined self-employment income, limited to no more than $345,000. Now, the Secure Act that came out a couple of years ago, Secure Act 2.0, permits an employer to make additional contributions to each employee of the plan in a uniform manner, provided the contribution doesn't exceed the lesser of 10% of compensation or $5,000. So there's a lot to unpack there. And I would encourage you to speak with your certified financial planner regarding those. We don't do a lot of simple IRAs with our clients. We tend to lean more towards those SEP IRAs and 401ks. The rules are very, very similar on the S corporations and corporations for those. Now, if you're an individual, you file an individual tax return, you can contribute to a traditional IRA at $7,000 per year, $8,000 if you're 50 or older. These are available to anyone with earned income, including self-employed individuals. It offers tax advantages with contributions being tax deductible, right? And then you get to pay taxes at the end there when you want to pull that money out. And this is a lower contribution limit compared to other plans, ideal for those looking for more control over those investments. And then you have the Roth IRA contribution, which I absolutely love. So this is the same thing. If you have earned income, you can go ahead and contribute to this. There are income limits. So if you earn over a certain amount, you can't contribute to this plan. That's the only drawback. But the money that you contribute is not tax deferred. This is after tax money that you've already earned, but the earnings grow tax-free until retirement. And then one of my favorite things here is the defined benefit plan. This plan typically combines an element of a typical pension plan. You can contribute a higher amount with a 401k style account. This is suited for those with high stable income and a desire to maximize retirement contributions, as well as tax deductions. We typically see these with CEOs, executives, and those that have high, consistently earning businesses year after year. The amounts that you contribute are actually determined to by an actuary, and that amount is determined by that table there. But you can fund up to $275,000 to your retirement account. So if you're, at a 50% tax rate, right? Federal and state, you save 100 plus $1,000 in taxes with that. When it comes to corporations and S corporations, the maximum of $275,000 still applies. So obviously there's a lot you can do when it comes to your retirement planning. And I encourage you to sit down with your certified tax strategist and your financial planner to come up with a plan to maximize your tax savings, as well as your retirement, as well as your wealth and your legacy. And if you plan things right, you might be able to come up with a plan to actually pay no tax on those earnings in the future, which should be really, really powerful. So we really focus and strive on helping our clients get to that 0% tax bracket by the time they retire. Now, I can't guarantee you're going to get to the 0% tax bracket, but if we can get you out of that 48 to 52% and get you down to 20 or 15 or 10, that's a whole lot better than where you could be. So once again, what I'm going to do is I'm going to put a link to our free tax playbook. You'll get a text from us when you opt into that. And all you have to do is text back the word retirement, and you're going to get a retirement cheat sheet outlining all of these numbers so that you can sit down with your tax strategist and your financial planner. And then if you do need help with that, feel free to book a call with our team. We can go into depth of, how much money we can save you and figure out how much you can actually set aside for retirement to get those tax deductions. So if you found this episode helpful, please share it with somebody who might benefit. Also, leave us a review. That really helps us out. And once again, I'm Jeff Trapp with the Tax Planning Pros, and thank you so much for joining me today. Have a great one. Bye-bye.